Home ownership was always a key factor in the American dream, but when people who can't own a home start buying them, they're pulling on a chain of bad events. This is how the domino effect, better known as the Great Recession or financial crisis of 2007, destroyed not only America's, but the whole world's economy. Was it linked to the 9/11 attacks, or was this just a conspiracy theory? Let's find out. The 2007 to 2008 financial crisis was the most severe worldwide economic crisis since the Great Depression of 1929. The primary cause of this crisis was the subprime mortgage crisis. A mortgage is a loan that allows people to buy a house up front, and it's something only people with a good credit score can get. That's how it always was, but in 2007, mortgage lenders tried to change the system, thinking that they were about to earn the easiest money ever. But things didn't go as planned. As already mentioned, people with low credit scores were not able to get a mortgage and buy a house. But since the housing market in the early 2000s was booming, people thought buying a house now would be a great investment, and it was. So, with a high demand, mortgage lenders felt like they were missing out on not giving the mortgage to people with low credit scores, and that's exactly what they started doing. Mortgage lenders started giving out their mortgages to anyone, no matter how low their credit score was, since in their heads, as long as they're secured by a contract, nothing bad can happen. At this point, no damage was done, but when investment banks with large capital saw an opportunity in this type of mortgage lending, they quickly bought thousands of mortgages from lenders and sold them to investors as something called mortgage-backed security. This meant that home buyers paid investors their mortgage payments, and on the other hand, these mortgage-backed securities enabled investors to profit from the mortgage business without the need to directly buy or sell home loans. Soon enough, lenders are facing endless demand for mortgages, more and more people are taking out credits to buy homes, and at this point, insurance companies also want to get their piece of the cake, so they start offering credit insurance to these home buyers. It didn't take long for the amount of insured credit to jump from $900 billion to a whopping $62 trillion. Just for comparison, as of 2023, there's roughly $40 trillion of narrow money in circulation in the whole world. Insurance companies knew they didn't have that amount of money in case anything went wrong, but as long as the prices of houses are rising, everything should be just fine. Even though potential home buyers with low credit scores are still afraid to take on such a risky opportunity as more and more people are buying houses, they too are starting to think it's safe. And that's when they start buying homes despite not having a possible way of paying off their mortgage. At the same time, investment banks are still buying mortgages from lenders and selling them packed as even riskier contracts than before. To simplify this, home buyers are the only thing keeping this awful mortgage market alive. It's only a matter of time when home buyers with low as well as home buyers with high credit scores will stop paying their mortgages. And as expected, it didn't take long. By October of 2007, 3% of all US home loans were in the foreclosure process. Foreclosure happens when home buyers fail to keep up with their mortgage payments, so to recover the owed amount, lenders take ownership of the house. And not only that, but 7% of the mortgage payments were 1 month past due. Insurance companies are now starting to panic as investment banks flood the market with foreclosed homes, now valued less than before. Supply starts to rise as there's no demand, and we all know what happens in that case. In 2008, housing prices did something nobody expected. They took a massive downfall which knocked over the first domino. All finance companies involved in this game are starting to suffer. Investment banks stop buying mortgages from lenders once they see the chaos they've made, and insurance companies are now facing thousands of home buyers who took a loan and insured it. This causes banks, lenders, and insurance companies to start shutting down. When people saw that this financial crisis had caused the Lehman Brothers, an investment bank with over $600 billion in assets, to file for bankruptcy, they knew the next few years would be tough. However, things don't just stop there. People scared for their money are now pulling out their money from bonds and stocks and putting it into treasury bonds. To make things even worse, companies that were relying on loans to operate are left without loaners, their vital financing source. But how did this affect countries outside the United States? Since it was a domino effect, it also affected any country that had trading relations with the US. But we can't forget the value of stocks. On October the 24th, 2008, many of the world's stock exchanges experienced the worst declines in their history, with drops of around 10% in most indices. And on the same day, the United States dollar, Japanese yen, and Swiss franc soared against other major currencies, particularly the British pound and the Canadian dollar. Global investors were seeking to put their money into safer currencies, and that's how the currency crisis developed. This led to many governments of emerging economies to seek aid from the International Monetary Fund. Whilst the drop in stock prices was compared to that of the Great Depression, President Obama had the audacity to say, buying stocks is a potentially good deal if you've got a long-term perspective on it. Yeah, I wonder why people didn't buy stocks at the time. They got enough money from the insurance companies. Since 2 million people lost their jobs in the last 4 months of 2008 alone, they struggled to survive, spending less money and further damaging the economy. The impact of the crisis was felt way after the crisis officially ended in June 2009, and the biggest irony is that the financial institutions who caused this whole disaster received most of the money from the government's rescue plans. But this is where things get even more interesting. A few years after the recession ended, people are getting back on track and the economy is slowly stabilizing. Considering that a significant proportion of the American population didn't have faith in the government at the time, theories about the financial crisis being linked to the 9/11 attack started to appear. Some of you may have already heard of the rumors about how 9/11 was a planned attack to cover up trillions of dollars that were mysteriously lost the day before the attacks. Whilst most of the people didn't fall for the conspiracy, the opinions still differed. This particular theory said that the recession was also planned out to substitute the vanished trillions and the damage caused by the attacks out of the pockets of American citizens. To this day, there is still no valid evidence which backs up this conspiracy theory. During the financial crisis, more than 8 million Americans lost their jobs. Nearly 4 million homes were foreclosed each year of the crisis, and 2.5 million businesses closed. Is this comparable with the 35 million jobs lost in America alone due to the recession caused by COVID in 2020, as well as the 5.4 million who lost their health insurance after losing their jobs? Well, yes and no. More people were left unemployed, and the price of gas, housing, and every other living need went up. But still, at least they got to keep their houses, and we can say that the recovery was quick. However, one thing is for sure, a nickel is simply not worth a dime anymore.